Hello, and welcome to Markets in Focus. My name is Joe Bell, and today I'm going to walk you through some of the most interesting financial market themes that I'm observing. And let's start with that inflation report that we received toward the end of this week from CPI. It was much lower than expected. That comes on the heels of the Fed cut that we received at the Fed meeting. But the Fed and market disagrees on the 2026 rate cut or the amount of those rate cuts. And then finally, a lot of discussion around Mag 7 and the underperformance of some of those big cap technology laden companies. Why I'm actually pretty encouraged by some of the performance of the smaller companies and the market breadth improving during the months of November and December. Now, November inflation came in lower than expected. On the chart here, we have the US CPI Urban Core Index year over year. Now, remember, the core index excludes the more volatile portions of that price index, food and energy, to give a more stable look at the less volatile areas of the market. The year over year on the core came in at 2.6%. If you prefer the headline, it was just a tick higher at 2.7%. Either way, it was much lower than expected. Initially, the bond market reacted very favorably with yields moving lower. Risky assets finished Thursday very positive and continued that momentum through the end of the week as we near the end of the year with the stock market near its all-time high from just a few weeks ago. With all that said, economists have some concerns when you look underneath the surface of how this report was calculated. Remember, the government was shut down for 45 days, and there were a lot of different reports and economic reports that were casualties of this, and that does include the October CPI report. So we did not receive October's. November's was laden with potential, I won't say mistakes, but economists saying that the way that they assume rents were zero in October and some of the other calculations and estimates that they made because of missing data has many saying that it was downwardly biased, and we'll get a much clearer picture of inflation over the next few months of the future reports. Now, with that said, the Fed and the market disagrees on the path of rate cuts in 2026. Both of them agree that it's going to slow. We're probably not going to get any cuts during the first half of next year. Part of that is because the inflation figure is still, even at 2.6, 2.7%, well above the Fed's target of 2%. The other side of the coin, the labor market, unemployment rate at 4.6%. Labor market has slowed. And as we look at the expectations from Fed futures on this chart, each one of these dates are the times in which the Fed is going to meet in 2026. These are the Fed fund futures. Said another way, this is the market's expectations of where they think the Fed funds rate is going to be at each respective Fed meeting through the end of next year. And as we forecast this out, remember the current range of 3.5 to 3.75%, we don't get below that until June of next year. So most are expecting the Fed to pause for a little bit as they digest the data between the labor market and inflation over the next few months. And the market expects another cut toward the end of 2026. That differs a little bit from the Fed. Each quarter, and this would be last September or December report rather, the summary of economic projections came out, and the median expectation for the end of year rate cuts from all the committee members was only one cut. So market says two, Fed says one. Let's be honest, neither really knows at this point. There's a lot of data that will ultimately determine it, but I think it's interesting as you look at the expectations of the market, slightly a little bit more accommodative than what the Fed's saying. And potential wild card to remember is that at the end of January, you have one of the committee members whose term will finish, and in May, Powell, the chairman, will be replaced by a nominee from Trump and his White House administration. So those are two seats that will be replaced by Trump nominees. And we all know how Trump feels about a hawkish versus a dovish Fed. And you should expect that two members, including the chairman, will be those that he believes are a little bit more likely to cut interest rates. And perhaps that's what the market's pricing in. Mag 7, we've been talking about it all year. Let's break down some of the performance because they have started to lag in November and December. The first chart on the left are three indexes. The S&P 500 was up from the beginning of this year through the end of October, 17.5%. Small caps have lagged at 12.4%. Still a pretty good year, but they did lag. Mag 7 large cap growth names, those have been the winners, and that's all we've been hearing about this year and last year, obviously. They were up more than 25%. But November and December is a different story. A lot of concerns about the AI expenditures. Is there a monster in the closet of all this AI spending? Is there going to be some sort of an outsized risk or bubble around AI? You started to see a repricing of those names. The Mag 7 down 0.4%, even more here during the past couple of weeks, but since October 31st, down 0.4%, dragging down some of the performance of the S&P 500 because of their weight. S&P only up 0.1%. But what's keeping the S&P afloat? Look at it. The old small caps up 2.3%. They are being favored because of the expectations of lower rates and the fact that rates have come down lower, and we're not seeing an outsized credit risk in high yield bonds. We're not seeing risk in terms of recession with the labor market just yet. And that is favoring that small cap. We think that's a good thing. We think this could be what that rotation or broadening out of the market could look like, is maybe the top line index doesn't have that to the rocket, to the moon rocket ship growth because of this rotation. But I think long term, this rotation and broadening of the market outside of the Mag 7, I think that could be a good thing for the long term continuation of this bull market. I want to thank everyone for watching. If you look at the stats, AAA expects 122.4 million Americans to travel at least 50 miles between December 20th and January 1st, that 2025 holiday season. That is significant because it's a 2.2% increase over last year, which just happened to be the record year of travel. So Americans are traveling out there. You're seeing not just pickups in driving, which are most of them, but also airlines, cruises. So that desire for consumer or experiences rather and services and things like that, that's a good sign for the economy. People are still out there traveling and feeling good toward the end of the year. With that, I want to thank everyone for watching. Have a great holiday season, and I'll talk to you next time.